And with no further ado, I'm going to hand over to my colleague Stephen Joske. Stephen is the director of our China Forecasting Service, the service that Lou mentioned earlier that forecasts 287 cities in China. And he'll introduce the rest of his panelists for a discussion on commodities, China consuming and investing. So, over to you, Stephen.
Thanks, Robin. So we're very much following on from the themes discussed this morning about Chinese overseas investment, but with a more specific on commodities. And we've got a rather eminent panel here today to help us. They're all Australians, but they're all very much China experts, and they've also got some very broad and varied international experience. So hopefully we can throw a different angle on the debates we've been having this morning. I'd like to introduce first of all Geoff Raby, Dr. Geoff Raby, who until August was the Australian ambassador to China, and is now in the private sector here in China, helping facilitate business between Australia and China. And Geoff has a very distinguished career in the Australian Foreign Service, including ambassador to the World Trade Organisation in Geneva, and also Australia's ambassador to APEC. And he's, by training, an economist. In the middle, we have Clinton Dines, whose current role is with Caledonia, a funds management and investment company. He's probably known to many in the audience as the former head of BHP in China for many years. Clinton's been in China since the 1980s and is one of Australia's real experts on actually doing business in China. He's also has some very interesting perspectives. Another one of his current roles is a director of Central Asian iron ore mining company. And finally, there's hold on, Alan was the head of the Australian Trade Commission in Beijing, and Alan's Alan is very much an extremely fluent Chinese speaker, puts the rest of us to shame. So he's spent many years in China, but has had a variety of postings around the world, including even Afghanistan. So to kick things off, I'd like to just raise the issue of, clearly, China is really dominant in the global market for commodities, and it's been a very rapid and new development. And the issue facing China is we've also noticed an increasing appetite to invest in commodity-producing companies offshore, both greenfields and existing investments. So one of the questions is, have they got the balance right? I mean, does China need to invest at all? Can it simply just purchase on open markets? Let me start off with Clinton. How do you feel about that?
Hello. Yep. Sure. Thanks, Stephen. I think that's kind of the right question to ask, and I think increasingly that's the question that the Chinese, at least at a policy-making level, are beginning to ask. China, came into the space of being acquisitive with respect to raw materials and energy assets in the sort of early mid-part of the last decade, and this was essentially security of supply driven, anxiety driven, concerns about the rapid rate of growth, rapid consumption that China was having, and the increasing proportion of China's consumption being imported, and the realization that a lot of the supply that had to be imported had potential for bottlenecks or constrictions or restraints of some description, be that discovering that a lot of the global oil supply was controlled by national oil companies or by a limited number of major multinationals, and discovering, for example, that a large amount of the global iron ore supply was controlled by a limited number of companies, and China becoming somewhat anxious about that. And the initial response, the initial reaction was, well, we've got to go out and buy some of it ourselves. Now that first sort of anxiety-based thrust of going overseas was demonstrably not terribly successful, but it did create a platform upon which China, articulated a strategy of going out, and many Chinese companies have responded to that over the years. I think the most interesting aspect of the way things have developed since I think the NDRC articulated the policy in 2003, one of the more interesting aspects of the way it's developed has been that over time there have been some false starts, there have been some mistakes, there have been some issues along the way, and as those lessons have been learned and reflected upon, I think you're beginning now to see the evolutions of some of those things from a policy that is more or less based on anxiety and more or less based on concerns about security of supply, and the response being simply one of we must go out and buy it and own it, to at least at a policy level a more nuanced response that contemplates what you suggested, where what China really needs to think about and is beginning to think about is the idea that what China really needs is lots of capacity. There needs to be lots of product available, and lots of product available is what actually creates the platform for security of supply, both in terms of availability and also in terms of pricing. So I think I'd make the initial observation that I do see that there's an evolution going on, that the nature of China's going out has not been a static process.
Yeah, thanks. Just a question for Geoff. Obviously, I think Rod and Bew's talk this morning highlighted the rapid growth of China as an offshore investor. And that means there's been a steep learning curve both within China and in the countries that are receiving this investment. It's a very new environment. How do you see that process evolving, given you're involved in it now?
Thanks, Steve. Look, just taking up from Clinton's point, because in a sense that's where he concluded that there's a learning by doing process, and you'd expect that there would be learning by doing, and early mistakes would be analysed and corrected. But I'm not so sure that what's coming to an end is the anxiety phase. I don't quite describe it as anxiety. But when you look at China's recent economic history, over the past 10 to 15 years, there's been a profound change. Something that's never existed in all of China's 5,000 years, however long the history is. And that is China has become utterly dependent on world markets for everything it needs for its own economic development. And my view is the reform and open door policy, when it was first implemented, was not about integrating China into the world economy on Ricardian principles of comparative advantage, but rather it was about a mercantilist self-sufficiency strategy. And it all worked fine, and China actually has lots of resources. When it was self-sufficient in oil to 97, it has lots of resources. But when a big population grows quickly and becomes rich quickly, then the resource base is not sufficient to sustain it. So the issue of China's resource security, its investment overseas, I think is driven by the fact that the resource issue is seen as an issue of national security, of the security of the nation, firstly. And secondly, I think there's an enduring deep mistrust in China of markets. If you look at all the big corporations, when they get big, the first thing they try and do is vertically integrate. Vertical integration is a distrust of markets, and then the conglomerates form. So I think you've got two very powerful forces driving Chinese investment offshore into the resources and energy sector, which means that whilst the Chinese may learn, coming now specifically to your question about how you manage foreign investment regulatory arrangements, be it in the United States or Europe or Australia, whilst there might be better PR, whilst there might be some attempt to develop community relations in countries where China's investing, the basic motivation I don't think will change, and it's about a mistrust of markets in terms of supplying the resources you need, and an issue of national security. And that last point, I think, puts us, the supplying countries, at somewhat odds with the Chinese, and that is, for us, we see this trade as purely commercial, but for the Chinese it's seen as something much other than just a commercial transaction.
Thanks. Yeah. Strikes me that one thing that's very clear, if you look at an economic perspective at China's offshore investment, it's clearly win-win. I mean, both sides are economic beneficiaries out of it, and yet we see the political systems in almost every country receiving Chinese investment is grappling with various forms of political opposition to this, which clearly isn't really related to the objective economics. So I wonder if Alan Morrell could just tell us from the Australian government perspective of how they manage those sort of tensions between setting up a regime to accept foreign investment and how the reality matches the perception.
Yeah, thanks, David. To some extent, I'm sure that a lot of people in the room are already well aware of China's significant investments in Australia, so it's a model that, to a large extent, has been tried and tested. There's a natural complementarity in our case as a supplier in China with all of that demand. I think the important part about the experience to date is that there has been largely successful accommodation of the 2 points that Geoff has just spoken about, between the political dimension and the commercial. The commercial is largely the focus, of course, of the specifics around any deal, but it has to sit within the community and with that political context. As part of that, there has been a range of perceptions and linking back to the learning from doing. I think on both sides we've seen that deal with this accommodation between the political and the commercial. The reality in the Australian context is that since 2007, 230 projects approved, $60 billion worth of investment, and only 5 with attached conditions and no rejections, is a fairly consistent track record of accommodating that difference. That's not to say that there haven't been issues, and that looking forward we can expect that there will still be some of those tensions, but by and large I think it's a model with some flexibility that tries to keep that tension in the right place and hopefully keep the emphasis on that win-win.
And to put that in a bit of context, Australia has a very long history of dealing with Chinese foreign investment. I think one of the earliest speakers mentioned the Channar iron ore project in the 1980s, and there's a similar very big aluminium investment by CITIC. And so in many ways the political debate in Australia about foreign investment was much more mature than in countries like Canada, which seem to be psychologically less prepared for it, and yet we've seen some fairly strange shifts in that opinion more recently, so it's not something that's been locked in. But Geoff, do you have any thoughts to add to that?
But I think Alan's numbers are very telling. There's been an absolute flood, an avalanche of mixing metaphors, but however to describe it, Australia's drowning in Chinese foreign investment proposals and projects, and in fact the strike rate's been very, very high. I think the point though then is what Clinton was making, is what's the quality of a lot of that investment, and is it all going to end up in tears as the Russian investment has often found its way into sub-commercial projects, or is my point right? Does it not matter, because this is not really about the commerciality of the projects at all, but it's about deep-seated psychological concerns about national security and distrust of markets. One thing, though, just at a general level, I've often said to Chinese investors is that when you go to a country like Australia, you have to actually try and figure out how a democratic society works. One of the biggest problems, I think, that Chinese investors in countries like Australia have is that they come from a society that they're unable to understand how the nature of democratic politics works. You know, the old cliche, all politics is local. And I've often said to Chinese colleagues, well, have you thought about building a country fire brigade or building a surf lifesaving club in Australia? And you can see them thinking, oh, the ambassadors, well, I was an ambassador, the ambassador's thinking about corruption. I say, no, that's not corruption, that's democratic politics at the local level. But that's what you need to do, and also there needs to be a lot more brand building. When Emirates Airlines came to Australia about 15 years ago, I don't think Australia would dream of flying on an Arab airline. But Emirates came, bought football teams, racing contests and so on, branded themselves as part of the community, and people see Emirates as just part of the community. I think that's another big learning process that Chinese firms have to go through when they're investing overseas.
Thanks. Actually, Clinton, I was wondering, you've obviously had a lot of experience with the Central Asian commodities sector. Do you feel that differs in any ways from, say, Canada, Australia or Brazil in the dynamics of Chinese investment and trade with the region?
I'm involved in a couple of companies, one in Central Asia and one in Africa, and the local politics with respect to Chinese investment in both those places is significantly more virulent with respect to the Chinese than it is in Australia. A great deal of anxiety and suspicion and you know, watching things very closely at almost every level of government and in the commercial world. And in the case of Central Asia, because they're right on China's doorstep, I think there's a lot there, and they're resource rich, so they have some concerns there. And in Africa, you know, there's a reasonable recent track record of Chinese involvement in investment, which has been patchy. It hasn't always been well conducted. It hasn't always conducted itself entirely appropriately. So people are responding to that and reacting to that. So that's I think the key issue there. When I'm talking with Chinese friends, you know, as Alan said, there's a lot of projects have been done in the last 3 years. A lot of money's come in the last 3 years, but the nature of that, the tone in behind that relationship, a very high strike rate, a very high success rate, a lot of things happening. But you wouldn't think that if you read the newspapers in China or you had conversations with Chinese counterparts up here. You would think that Australia was the most nasty, hostile, unreceptive place in the world. You know, just go and talk with some of the investors around there. They're always nagging us about the next thing, and you know, God forbid that one suggested we're being gamed to any great extent. But I think there is a set of misperceptions around Australian receptivity. At the same time, you've also got to remember that on the Australian end, you had Chinese investment, correct me if I'm wrong, Alan, Geoff, but I think 2005, 2006, or 2006 to 2007 go from sort of 1 billion a year to 30 billion, or applications for investment. And you just can't have that happen with money coming from a new source. It's not coming from America or Japan or places that everyone's used to. It's coming from a place that hasn't invested before. You can't dial up that rapidly and not expect a reaction. So again, I think there's this learning curve and the evolution of, you know, of the learning by doing. People at a policy level, at a foreign affairs level, at a corporate level, etc., acquiring the experience and understanding the context in which they're working, and things settle down. We had it with the Japanese in the 1980s, where people got very anxious. I was growing up in Queensland in the 1960s when both the Americans and the Japanese were buying up all the coal mines, and that caused a lot of angst at the time. Everyone gets over it eventually. And also as Geoff alludes, the foreign parties also learn to work within the context that they're investing into, and things do get a bit easier. But I think the flip side, and you allude to what I said earlier and what Geoff talked about, is that China has come out in a rush, and China is not the world's most experienced overseas investor, overseas operator, overseas transactor. At the moment, commodities prices are very high, there's a lot of demand, everything looks good, but quite a lot of money has gone into things that I dare say will be proven to be suboptimal in the long run.
One final question to the panel before we move on to questions from the audience. State-owned enterprises, you know, they very much dominate the Chinese economy, even if they aren't truly most of it. But they certainly dominate the commodities sector in China. So, Alan, what do you think's your response to that as an investment receiving country?
Well, the Australian government's taken a fairly clear position around sovereign wealth funds and state-owned enterprise as part of that, with some guidelines as to how they can invest in the Australian economy. And that's partially, I think, in response to some of the points that Clinton's just raised there around a very rapid increase and reflecting perhaps some of the questions being asked about the motivations behind it. And maybe this goes back to the points that Geoff mentioned as well. The response to that has been, one, to present guidelines that does treat state-owned enterprises of foreign countries in a different way to private enterprise. The attempt there, though, has also been to, whether they're from China or Singapore or other countries, to try and deal with them in a consistent way. And that consistency and clarity is regarded as the best way of dealing with the set of issues that might be attached to those pertaining to a state-owned enterprise.
So finally, Geoff.
Just a comment with state-owned enterprises in particular, I think. It comes back to sort of politics and understanding how a different society works. In China, the hardest thing to do is to get through the front door and talk to a minister or a vice premier and make your pitch and get them on side and pick up your case. In a democratic country like Australia, I'm sure the UK and others are the same, the United States, the easiest thing is to get in the front door and to see the minister or to see the senior decision maker. The problem is that in our systems, when you get through the front door, you've actually got to then help the politician, the minister or whatever, help you, assuming they buy your case. Whereas in China, once you're through the front door, when you finally get through the front door, if they like your pitch, then everything's fixed, the telephone's picked up and all problems are sorted. And so it is, they're just two worlds apart. And the problem is, I think, SOEs are so much embedded in the Chinese way of doing politics and business. It's very difficult for them to see how it operates and to work in a completely different system overseas.